Well, I wouldn't call it acceleration, Steve. I think what you called on it earlier is true, in which, it's hard to determine what kind of landing we're actually going to see because you have strong headline GDP that's being brought on by a very strong consumption. But if you look a little bit deeper, it looks like this may be the last gas of the consumer. It looks like credit is being used much more in the past several months. And I think as we look forward to start to look into 2024 numbers, you're going to see some real softness start to occur. And as you just touched on, I mean, you brought up a great point. I mean, it's easy to see GDP, greatly above trend when, the fiscal imbalances of the government with, 120% of GDP, debt to GDP, or 6% budget deficits. That's going to prop up a lot of spending, and that's going to help prop up the economy for a bit of time. So I think that's what we're seeing today. But I also think we're just in a world of risk right now as well. So it's going to get a lot more dire, I think, as we look forward.
And we'll go for that. But, David, it's not looking dire at the moment. And this is what is defying expectations. I don't think any of us out there, whether we're bulls, bears, transitionary inflation or longer-term structural inflation, I don't think any of us can say that we would have expected the economy to be performing at nearly 5%, in fact 5% once you've taken the decimal out, 5% given the massive rate increases we've had as well. Why is the cumulative and lagged effect that everyone talks about, that the Fed talks about, that Powell talks about, why is it taking so long, David?
I think it actually goes back to 2021. You and I had a discussion back then. My viewpoint from Livermore and our fund was that inflation is now structurally embedded in our economy, and we're going to see that as a go-forward basis. And I think that's actually true today. So I think ultimately you're going to see this sort of stagflationary environment play out for a bit of time. Rates are rising faster due to higher inflation brought on from 2021. That created a wealth effect. That created tremendous liquidity in M2 money supply. And that creates a lot of wealth. And of course, since then, you saw inflation go higher. You saw the labor market get much tighter. And I think it just takes time where the Fed has had to ratchet up the Fed funds rate dramatically, over 500 bips at this point. And it just takes time for that to work through the system and for people to cut out the spending. And to me, that's, I thought like you, it was going to happen much sooner into 2020, 22, and that didn't occur. But it looks like more than likely it's going to bleed into the end of here 23 and going into 24 at this point.
David, can I ask you about the bond rout that we've seen? The markets have been jumpy around the data. We got through the growth numbers yesterday. But if you look at the bond rout at this point, how dangerous is that for equities?
I think it's tremendously dangerous at this point. Like I said, I think we're in this world of risk where for almost 15 years you had a bond market that was in a bull market, and you had rates negative for several years, and that dynamic fed throughout the global economy where housing prices were affordable, autos were affordable, and people were subjected to an environment and a lifestyle, I should say, which had much lower interest rates. I think that has changed, obviously, in a 180 here, and I think that is going to cause a lot of the pain moving forward in terms of the economy. So I think what you're seeing now with the bond market is, bond vigilantes are back in vogue, back from the 80s, back from the dead. And I think they're leading the market today. It's not the Fed anymore. And as you look at sort of this fiscal imbalances happening, it's giving a lot of ammunition to the bond bears. And thus, you're seeing interest rates rise much further than expected. And I think that's going to cause a lot of pressure on the credit markets. It's going to cause a lot of pressure on the consumer going forward, and even corporations when there's a lot of debt refinancing going on as well. So I think ultimately that will lead to the downtrend of the economy, and also it's going to hurt the stock market, and you're starting to see that today.